Futures are adding to Friday's somewhat surprising gains. For more on the markets, let's bring in Tom Lee, head of research at Fundstrat and chief investment officer of Fundstrat Capital, as well as a Cnbc contributor. Last time you were on, Tom, you said, I think we can, and it was definitely one of your what seemed like outrageous calls at the time. You said, we'd be at 5,500 on the S&P. We should be able to get back there fairly easy. I think we were below 5,000 at the point. We did get close. We got another pullback, but after Friday, we're almost at 5,400 again. What was your reasons for thinking that? I think you just thought that maybe if you see a cat and you keep clapping, it'll jump the first time, but after a while, it finally just ignores you. Is that going to happen with the markets and all this tariff backdrop?
Yes. I mean, I think I know what you're saying, which is I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah. And I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there. And the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks.
Interesting. So when we were below 5,000 and you were on the S&P and you were at 7,100, that's like 40%. So you're now, and were you one of the high people on the street at 7,100? Were you there?
Well, our year end originally was 6,600, but we thought we could touch 7,000 mid-year. Okay. I think the 6,600 is still possible, but I do think the 7,100 mid-year is obviously it'd be very difficult to reach. So but it's possible. 6,600
by year-end. What about you've made a lot of good calls based on moderating inflation. What did you make those numbers at the end of the week?
Well, I think that if we didn't have to consider tariffs, inflation is definitely tracking below expectations. I mean, core inflation month over month at 0.00056. I mean, that's like literally hitting a wall.
Now, is that for good reasons or for bad reasons?
I think it's for the right reasons because,
oil?
Yeah, well, there's oil and foods off the boil, but it really is shelter is actually cooling to a 2% rate, and that is what you need to get inflation back down to 2.
Do you, at this point, foresee the worst-case scenario in terms of dollar declines, 10-year yields due to people the Journal had an interesting piece today that it doesn't need to be that people just abandon the dollar and abandon the United States to invest in. It's just on the margin because it's a given that you cannot ignore the United States as the elephant in the room globally for all these things, for the the currency, investments. But on the margin, it could make a big difference if there was even a slight lessening of what we were used to.
Yeah, I agree. I think that is the narrative at the moment that, U.S. exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the U.S., the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And, if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the U.S. because of the dollar? And I doubt it. And I think U.S. companies are going to adapt.